Welcome back to the channel. If you have watched our previous videos on Dow theory and candlestick patterns, you already have a solid foundation in how markets move and how to read price action. Today, we are going to build on that foundation with one of the most important and universally used concepts in all of technical analysis: support and resistance. Once you truly understand this concept, the way you look at price charts will never be the same again. Let us get started. Section 1: What is support? Let us start with support. In the simplest possible terms, a support level is a price level at which a falling stock tends to stop falling and bounce back up. Think of it like the floor of a room. When a ball falls and hits the floor, it bounces back up. In the stock market, when a price falls to a support level, buyers tend to step in because they feel the stock is attractively priced at that level. This buying pressure stops the fall and pushes the price back up. Why does this happen? Because at certain price levels, there is a concentration of buyers who have decided in advance that they want to buy the stock if it comes down to that price. These could be long-term investors who missed buying earlier and are waiting for a dip. These could be traders who bought at that level previously and know it acted as support before. When the price reaches that level again, all these buyers step in simultaneously and create enough demand to stop the fall. A support level is not an exact price point. It is more like a zone or a range. So instead of saying support is exactly at 1000 rupees, it is more accurate to say support exists between 980 and 1020 rupees. Prices rarely turn at an exact number, they turn within a range. Section 2: What is resistance? Now let us talk about resistance. Resistance is the opposite of support. A resistance level is a price level at which a rising stock tends to stop rising and pull back down. Think of it as the ceiling of a room. When a ball is thrown upward and hits the ceiling, it comes back down. In the stock market, when a price rises to a resistance level, sellers tend to step in because they feel the stock has become expensive at that level. This selling pressure stops the rise and pushes the price back down. Again, why does this happen? Because at certain price levels, there is a concentration of sellers. These could be investors who bought the stock at a higher price, saw it fall, and are now waiting for it to come back up so they can sell and break even. These could be traders who shorted the stock at that level previously. When the price rises to that level again, all these sellers step in and create enough supply to stop the rise. Just like support, resistance is also better understood as a zone rather than an exact price. And just like support, it is based on the collective memory and behavior of market participants. Section 3: How to identify support and resistance. Now, the practical question: how do you actually identify support and resistance levels on a chart? The most basic method is to look for price reversal points on a historical chart. Open any stock chart and look for levels where the price has bounced up from the same area multiple times. Those are support levels. Look for levels where the price has been rejected and turned down from the same area multiple times. Those are resistance levels. The more times a price has respected a particular level, the stronger and more significant that level is considered to be. Round numbers tend to act as very strong support and resistance levels. Levels like 500, 1000, 1500, or 2000 rupees tend to attract a lot of attention from buyers and sellers simply because people naturally gravitate toward round numbers when setting their buy and sell orders. You will notice this pattern repeatedly if you study enough charts. Previous highs and previous lows are also very important support and resistance levels. The highest price a stock has ever reached, its all-time high, tends to act as a very strong resistance level because many people who bought near that high and are sitting on losses will want to sell when the price comes back to that level. Similarly, the lowest price a stock has recently reached tends to act as a support level. Section 4. The Role Reversal Concept. One of the most fascinating and powerful concepts related to support and resistance is what is called role reversal, also known as polarity. This is the idea that when a support level is broken, it often becomes a resistance level, and when a resistance level is broken, it often becomes a support level. Think about why this makes logical sense. Imagine a stock that has been bouncing off a support level at 500 rupees multiple times. Many buyers have bought the stock at this level, trusting that it will hold. Now imagine the price breaks below 500 rupees decisively. All those buyers who bought at 500 are now sitting on losses. They are waiting and hoping for the price to come back to 500 so they can sell and get their money back. This creates selling pressure every time the price approaches 500 from below, turning the old support into new resistance. The same logic works in reverse. When a resistance level is broken and the price moves above it, all the traders who were waiting to buy a breakout will start buying, and those who sold short at that resistance level will be forced to buy back their positions, adding more upward pressure. This collective buying turns the old resistance into new support. This concept of role reversal is incredibly powerful when you combine it with your knowledge of candlestick patterns. For example, if you see a hammer candlestick forming right at a strong support level, that is a much more reliable buy signal than a hammer appearing randomly on a chart. The support level and the candlestick pattern are confirming each other. Section 5. Support and resistance with volume. Volume is another important factor to consider when analyzing support and resistance levels. A support or resistance level that has been tested with high volume is considered much stronger than one tested with low volume. High volume at a support level means that a large number of buyers participated in defending that level, which makes it more likely to hold in the future. High volume at a resistance level means a large number of sellers were present at that level, making it more likely to act as resistance again. When a support or resistance level is broken with high volume, it is considered a much more significant and reliable breakout than one that happens on low volume. A breakout on low volume is often a false breakout. The price briefly moves beyond the level but then quickly reverses back. Always check the volume when you see a breakout or breakdown from a key level. Section 6. Practical application. So how do you actually use support and resistance in your investing or trading decisions? Here are some practical ways. First, use support levels as buying opportunities. When a stock you like pulls back to a strong support level, that is often a good time to consider buying, especially if it is accompanied by a bullish candlestick pattern and increasing volume. Second, use resistance levels as selling or profit booking opportunities. When a stock you own rises to a strong resistance level, that is often a good time to consider taking some profits, especially if it forms a bearish candlestick pattern at that level. Third, use breakouts and breakdowns for momentum trading. When a stock breaks above a strong resistance level with high volume, it often continues moving up significantly. Many traders enter positions on such breakouts anticipating a strong move. Similarly, when a stock breaks below a support level with high volume,
it often continues falling, and traders may consider exiting or shorting. Fourth, always use stop losses based on support and resistance. If you buy near a support level, place your stop loss just below that support level. If the support breaks, your stop loss will protect you from a larger loss. This is how professional traders manage risk using support and resistance. Section 7. Common mistakes to avoid. Let me quickly cover some common mistakes beginners make with support and resistance. The first mistake is treating support and resistance as exact price points rather than zones. As we discussed, these are areas, not precise numbers. Give the price some room to breathe around these levels. The second mistake is ignoring the time frame. A support level on a daily chart is much more significant than a support level on a 5-minute chart. Always pay attention to which time frame you are looking at. For long-term investing, focus on weekly and daily chart levels. For short-term trading, daily and hourly levels are more relevant. The third mistake is not waiting for confirmation. Just because a price reaches a support level does not mean you should immediately buy. Wait for a confirmation signal, a bullish candlestick pattern, a bounce with increasing volume, or some other indicator confirming that buyers are indeed stepping in. Section 8. Static versus dynamic support and resistance. So far, we have been talking about what is called static support and resistance, fixed horizontal price levels that do not change over time. But there is another very important type called dynamic support and resistance.
Levels that change and move along with the price over time. The most common examples of dynamic support and resistance are moving averages. A moving average is simply the average price of a stock over a specific number of days. For example, the 50-day moving average or the 200-day moving average. In an uptrend, the 50-day moving average often acts as a dynamic support level. Every time the price dips down and touches the moving average, buyers step in and the price bounces back up. In a downtrend, moving averages act as dynamic resistance. Every time the price rises up to the moving average, sellers step in and push it back down. Trend lines are another form of dynamic support and resistance. A rising trend line connecting a series of higher lows acts as dynamic support in an uptrend. A falling trend line connecting a series of lower highs acts as dynamic resistance in a downtrend. These trend lines move with the price and give you a constantly updating picture of where support and resistance exist. Understanding both static and dynamic support and resistance gives you a much more complete picture of where significant price levels exist at any given time. When a static horizontal level and a dynamic moving average or trend line coincide at the same price area, that is called a confluence zone, and it is considered an extremely strong and reliable level that the price is very likely to respect. Section 9. Psychological levels and institutional support. One more important concept to understand is the role of psychology and institutional investors in creating support and resistance levels. Outro. Support and resistance is truly the backbone of technical analysis. Almost every other concept in technical analysis, whether it is candlestick patterns, moving averages, indicators, or chart patterns, ultimately comes back to this fundamental idea of price levels where buying and selling pressure concentrate. Master this concept, and you will have a massive advantage in understanding how markets move. If you found this video helpful, please like and subscribe for more content on stock markets and economics. Thank you for watching.